So what we're going to talk about today is just a portion of that regarding to the financing. And I don't want to overwhelm you two, just brand new, so just raise your hand, yell at any questions, and what this is designed for more is just a discussion more than anything.
Okay.
So ask any questions. But this does not replace when you first start me going through the purchase agreement start to finish with you as well. This is just more of a dialogue to answer any questions. Really what it's meant for is when like Kristen and Anna are doing transactions and then they come up to a circumstance, you don't really think of the questions till you're living it, right? So this helps prompt those sorts of questions. So what you guys want to talk about was financing, right? So this is the first 4 pages of a state purchase agreement. And just to back up a little bit, I'm going to shut this here quick. There used to be a standard purchase agreement, and then you have addendums for everything. So there was an inspection contingency addendum, there was a financing addendum, there was a closing cost addendum. What they did about 2 years ago is they got rid of all those addendums and put that language into the purchase agreement, which is, in my opinion, great. You don't have all these extra addendums. So what we're going to do is we're going to kind of start at line 36 and just kind of go through it piece by piece and then answer any of your questions, because what you'll find now is it's specific to the types of financing of the offer. So line 37, this is where you direct the offer. The seller wants to know how the buyer is going to pay for the house. So you put the percentage of cash and the percentage of financing. Line 3 and 4 where it says assuming the seller's mortgage and contract for deed, let's just forget that for now, we'll come back to that. That's very rarely used. So typically if it's 20% down, you put 20% and 80% in line 2. Very straightforward. If it's FHA, it's usually 3.5% cash down. If it's rural development, it's 0% down, or VA, it can be anywhere in between. A lot of times it's 0% down, or they still may be putting money down. Rural development and VA are the 2 primary loan vehicles that are 0 down, that you can get financed for 0 down. Notice it says up to. So a lot of times you'll have people that might be either right on the cusp of putting 20% down, and 20% is kind of the magic number because then you avoid private mortgage insurance, which is an extra monthly payment. So if you're in that situation where if you put 15% cash and 85% here, they can still bring 20% down. It's not locked in stone. So whatever number you put for cash down, it says the sale price in cash or more at the buyer's discretion. So they can put more than 15% if you put 15% down. But they have to put at least whatever you put in there, so they can't bring 10%. Make sense? We'll come back to lines 3 and 4, assumption and contract for deed. And then the closing date is the date of closing. If you flip the page, and it says this purchase agreement is or is not subject to mortgage financing unless it's an all cash deal. It's going to be subject to mortgage financing, so you want to check is. And then lines 52, 53, a first mortgage or a first mortgage and subordinate financing. Subordinate financing really doesn't come into play anymore. It used to be 10 years ago, you used to get a first and a second mortgage to come up with that. That really doesn't exist anymore.
Okay.
So you're almost always going to just check first mortgage. Even if there's down payment assistance or anything like that, that's going to lead into line 54 where it says financing does or does not include grant, bond program, or loan assistance. So you need to disclose this to the seller if you're writing an offer. The typical real life scenario on this one is Minnesota Housing Finance. So which is typically an FHA product. So if it's an FHA loan, and this is where it's important to have direct communication with the buyer's lender, because you're going to want to know what type of financing, and they should tell you, and they typically do, we're using Minnesota Housing. That's what they'll say, Minnesota Housing for that. If they're using Minnesota Housing, you would check Financing does include grant, bond, or other loan assistance program, line 54. You need to have that in there if they're using Minnesota housing. And then you'd still check either 57 through 61, conventional, VA, FHA, privately insured conventional, or USDA. Does that make sense?
How often do you see privately insured?
Not very often. Not very often. What you're typically seeing is just conventional, VA or FHA, or USDA. Now, USDA, and I'll just kind of backtrack, USDA has, it's either referred to as USDA or Rural Development. That's a zero down loan program, which is very desirable for buyers because you don't need a down payment. There are what we call maps or certain areas which change. There's a website, you have to find out if the property is eligible based on the location. So for instance, there's nothing in Sauk Rapids proper that qualifies, or Sartell, with the exception, there's probably like 3 blocks up northeast of Avalon, northwest of Avalon that qualifies. The key thing to remember is these maps are always changing. So a house that may be on the border, and it's just going to take familiarity of knowing the areas that qualify. So St. Joseph qualifies, Rice qualifies. But what you don't want to have happen is you don't want to lead your buyer into a house with rural development financing, and then based on the location of the house, it doesn't qualify. Because that location of the house is what qualifies for rural development financing in addition to the buyer's finances. So that's just something to be aware of. And there's a website, the USDA website, you can punch in the address and it'll tell you if it qualifies or not. Or come see me also. Once you learn, you kind of know where the areas are, and if it's right on the borderline, like there's just a spot in Sartell that's always fluctuating. And so that you just know to check that. And don't necessarily rely on what's in the MLS. It may be advertised as rural development eligible in the MLS, and that could be either an input error or the agent just throws it in there. So, because that can be kind of a sticky situation. If you get your buyer excited, you write an offer, and then you gotta kind of pull the plug or something like that. So, and the other thing, just a complete side note, because it just happened, is rural development financing was the one type of financing that was affected by the government shutdown. And not that'll happen again anytime in the near future, but a lot of deals were on hold indefinitely, which cramped a lot of people's plans, so just something to be aware of there. The next section is the loan will not be amortized over a period not more than, and typically you're always going to put 30 years, unless someone's getting a 15-year mortgage, and you will see every once in a while someone doing a 40-year mortgage. I've seen TCF do that a little bit here now. I've seen it once or twice in the last 2 or 3 years. Typically you're always putting 30 years in there. And then with an interest rate not more than, you see line 64, blank percent per annual. The intent of this line is to protect your buyer. So right now interest rates are typically between 4.25-ish, 4.5, somewhere in there. What this is saying is if interest rates overnight skyrocket and go from 4.5 to 6, this is meant to protect your buyer because they may be buying their house based on a payment of $1,200 a month. Well, if the interest rate goes up a point, that could affect their ability or willingness to want to buy that house. So if that does happen, you're capping what the interest rate they're obligated to buy the home at. Now, realistically, do interest rates in my whole time in this business, have they overnight gone up a point? No. But this is protecting them from that. So what you'll see is people put, like right now I'm putting 5% in there just to kind of protect them. What you will see, and what I would strongly discourage you from doing, is you will see agents just put the word market in there. And so what that means is it really is not doing your client a service by protecting them, because it's saying they're not obligated to buy the home if the interest rate is more than X percent. Well, if it's market, it's whatever the market rate is. It's really doing that, in my opinion, that's just kind of a lazy practice, but you will see that quite often. I would strongly discourage that, even if you put 6.5 or something, put something in there other than market. I think Krista just had one where the seller actually countered this, right? They wanted it up higher.
Sure.
Yep. Which, again, when you're negotiating a deal, this is a whole nother topic. There's things that, what I tell a buyer is we're gonna put everything in our best interest and see what they counter back in, because they could counter back a lot more items than just price, right? And so if they're gonna counter back line 64, raising it from 5 to 6%, it really is, in the big picture, it's not gonna matter. I'd rather negotiate a better price and have them bump that up, you know what I mean? So you're kind of picking and choosing what's important when you're negotiating. But Krista just had a seller where they countered that item, so.
What'd you have it at?
I had it at
5, and they wanted it.
6.
And that's just,
It was just that, I mean, granted.
Well, how often is that being a deal breaker? What if,
Right.
what,
It
did you
was
say
just-
no?
Well, no, but it was just an interesting
Yeah.
counter.
Yeah.
Maybe there were other things,
Yeah.
but I just thought it was interesting. I don't know.
yeah. So in that scenario, you just say, okay, that's, because the risk on that is
Yeah.
very minimal at all. That it's even gonna reach 5, let alone 6, so focus on what's more important, so. But the expectation when you're sitting down with the client, writing an offer, that's what I say is we're putting all of this in our best interest, and we'll see whatever they come back. They can counter anything and everything in addition to price, because a lot of times buyers are just fixated on negotiations on price. There's really a lot more terms in an offer that can be countered. If you read line 65 through, any questions on that? Sorry, I didn't mean to.
In that scenario, what is that even doing for them? Because your buyers are already locked in at their rate, right? And not locked in,
I
but,
don't know that they're locked in, but for the seller, it's not doing.
yeah, like.
I mean, maybe she's feeling like it's protecting her, that 1%, but
Yeah.
it's really, I mean, I think it was like at 4.6.
Okay.
Yeah.
And it was
So it just, it
4.4.
was giving her a little more security to say,
Yeah, I think I think she's trying to find ways so that they can't back out.
Mhm.
Not that they're
yeah,
going
yeah,
to, but I
yeah.
think that's her concern.
Okay.
That's interesting.
Just from what
Mhm.
I gathered.
So line 68 through 88, and I think this was kind of what you wanted to cover, Anne, right? The two options of Krista is, so what I tell people is you have a pre-approval letter that shows the seller that the buyer's pre-approved. Anything can happen depending on the letter, and people joke with me here that I always say anybody get hit by a bus, but more realistically, people can lose their jobs or something catastrophic happen where they would then get relieved of their obligation to buy the house, and they typically would get their earnest money back because it's contingent on financing. So and this is kind of a good discussion for your sellers, is if a purchase agreement is contingent on financing and they get a lender letter that says they no longer qualify, something's changed in their financial situation that they can no longer buy the house, they are relieved of their obligation to buy the house. And what I tell sellers is there are inherent risks in every real estate transaction. My job is to try and minimize those risks for you, and that we do that by a pre-approval letter, ideally with a lender that we're familiar with. And what I say is there's no red flags from what I called the lender, I've done everything, but if they lose their job, there's inherent risk involved. So our job is to try and minimize the risk or look for red flags, but we can't eliminate the risk, right? So this section talks about what were to happen if the buyer cannot secure the loan. And there's all sorts of scenarios where lenders, they can count the overtime appropriately, or the buyer, heaven forbid, wasn't upfront or not knowingly said, oh, I typically get this overtime, but they did the last 6 months and now that income can't be used. Anything like that were to happen, what I would say is always from our brokerage perspective, if you're writing a offer, you want to start with checking line 70 and refunded to buyer. And you will see that in 95% of the deals or higher to begin with. Now there are scenarios where we can negotiate those, but I would say any offer you're writing for a buyer, you want to say, and I'll read this, line 70, if buyer cannot secure the financing specified in this purchase agreement, and this purchase agreement does not close on the date specified, the purchase agreement is canceled. Buyer and seller shall immediately sign a cancellation, confirming said cancellation and directing all earnest money paid, and then you select either refunded to buyer or forfeited to seller. If you're writing it for the buyer, you want to check refunded to buyer and check box 70. Does that make sense? Now, I had a instance here just a couple weeks ago where we did a closing. It's a physician moving from North Carolina, buying a house literally from FaceTime and online, hasn't been in it, did the inspection, the inspection's happening today, but we're not closing till July. And so what I told the sellers is, this is a solid buyer, we got a good price, but there's the old saying of time kills all deals. There's some inherent risk involved in just waiting till July, mainly that we're taking your house off the market all spring. So what we negotiated is after the inspection period is the earnest money is non-refundable, $5,000 to a higher end home. So that earnest money is non-refundable. And so we have a clause, and so just to back up a little bit, we can kind of go through the specifics in what's called Instinet, where all the forms are online, where we have the standard forms, but we also have a lot of clauses designed to help you with different situations. So we have a clause that says basically the earnest money is non-refundable after a certain point. So there are times where I said you always want to check this box, refunded to buyer, but there are times where it makes sense where you will negotiate things like earnest money to be forfeited or non-refundable. I don't know, Heidi, you have any scenarios that you can think of where it does make sense in a particular case?
Well, I think you're going to ease your way into a lot of those things, but one of the things that I always, a lot of times, the best buyer you can have is cash, right? Cash is king. But in a cash transaction, you don't see necessarily the things happening throughout the transaction that indicate to you that everybody's still engaged. So for example, after you get the inspection done, at that point, you're not seeing an appraisal generally because it's cash, and then you're also, you're not having any back and forth with the lender telling you things are happening. You're basically doing an inspection, and then you have like this time of no communication. So a lot of times on my cash deal, I'll bump up earnest money to be a higher amount, and not in some cases non-refundable. Well, really with cash it is non-refundable at that point because there's no contingencies, but having it be larger in those situations. But yeah, there's.
How long is an inspection period generally?
It's negotiable, so
Okay.
it's one of those where it's, in the spring, this last year, we've seen a lot of people bump up to about 12 days, because the timing to get an appraiser in there and get through it is
Inspector.
the inspector. But yeah, but like right now, all the agreements I'm writing are 10 days. About 5 years ago, they were all 7 days. But then there was like a clause where you had additional days to get negotiations done. So really about 10 days is probably your average.
So what I would still recommend when you're writing an offer to the buyer, you still want to put refunded to buyer. If the seller comes back and counters earnest money non-refundable based on the situation, that's when you deal with that. But never offer that up when you're representing a buyer, right? So the next section, starting lines 76 through 88, which is very rarely used, and to me, it's not as practical as the intent is. What this says is, this is in the scenario where a seller doesn't want to wait until the last minute to find that there's an issue with financing, which I totally understand, but in this day and age, lenders are doing employment verifications the day of closing. And so it's really truly never clear to close until closing a lot of the times. But what this is saying is buyer shall provide seller or licensee the written statement on or before a date. And a lot of times you'll see a date 3 or 4 weeks out there. And what this is saying is after the lender provides a written statement that the appraisal's been done, preliminary underwriting's done, after that point, the earnest money's non-refundable. Does that make sense? Again, never do this when you're representing a buyer. And so there are situations where it makes sense for a seller to come back and do this. Let the seller come back and say, here's why we want this, but then the onus is on you representing the buyer that you have to explain to them, if something changes or something goes south after this date, your earnest money is non-refundable.
So this is basically the counter from the seller. You really only see that because I've never seen it.
Yeah, well, and what I have experienced is that comes over as a counter from metro area agents
Yes.
quite a bit, because they use it in the metro area a lot.
Okay.
And, just because people, it's kind of the same thing, they want some guarantees.
Yeah.
And sometimes my people are like, I don't want to pack until I know this is a done deal.
Sure.
I don't want to put all my stuff on a truck until I know it's a done deal, or at least I have some way to quantifiably take care of some of that expense. And really, there's like one brokerage that I see used at the most in the metro area too. So they must have had some education at some
Sure.
point saying, this is how it's protected somebody, and then people jump on a bandwagon.
Okay.
And that's one nice thing in our area, you do see some of that community coaching where it's like, oh, XYZ agent put this in as a clause that really makes sense and it protects everybody. So then you start using some of the same language in your own purchase agreements as clauses as well.
And again, there's nothing inherently negative or bad about using either of these options or the second option. The main thing what I would stress is you want to make sure you and your client understand what you're agreeing to, right? That's the main thing, is you don't want your client to learn that the earnest money is non-refundable after the fact, right? Now,
Do you have banks that can't get that done, or
no, I mean,
you're just
typically-
staying in closer contact with your bank?
yeah, typically you can get the lender, the loan officer, to write a written statement. But what I would say is each loan officer lender only has so much control over their underwriters
Or their client.
or their client. I mean, you could be waiting on their client to deliver documents, right?
Yeah.
So, no, you don't have, I haven't had trouble getting something in writing, but there could be other pieces behind the scenes that they have limited control over to be able to commit. And again, a full underwriting clear to close doesn't typically, there's always something occupant or not occupancy, employment verification is always happening. I mean, so it's never truly done until the day of closing when the buyer.
Like minutes sometimes. I'm like freaking out.
Yeah.
Like, I need that
Yeah.
quick close.
So again, there's nothing bad about using this, and I would say and in this day and age, when you're representing a buyer and you're getting into multiple offers, and this is a whole other training altogether, there's ways to structure your offer that's more advantageous to get your offer selected. And part of that is just getting experience to say, okay, we're going to offer this up and make sure they understand if we're doing non-refundable earnest money. They gotta know the risks, but there are little subtle things you can do where a seller will wanna feel more comfortable with their offer. We want this part selected and changed. I'm gonna say, this is the difference between probably getting the house or not. How comfortable do we feel with your lender that you're able to do this? And possibly recommend doing this if they want the house, but they need to know that there is some additional risk.
Well, and it's the logistics, like when you look at this other clause without getting too detailed, it basically says, so the written statement doesn't come from the lender on time. And you're at that way 4 weeks into the purchase agreement, people are really ready to leave and, they've already started packing. It's on the seller to actually, cancel the agreement. Like there's a clause in here that says, if we don't have the written statement, we can cancel and keep your earnest money. Well, if they've packed up their house and they're a week from closing, because that's usually the time frame that they're not gonna cancel. So the risk would be in our area too, when you have earnest money that's a little bit more calculated, it's just, your risk isn't huge there. It's one of those where yeah, let's just sign
Well-
it because.
And Chris and I were talking about this on a contingent offer. Once an offer is executed, it takes, for a seller to call a bluff like that,
Yeah.
they want it to close, that's all
Yeah.
they want. So
Yeah.
they're not going to, they're doing this with their intent of trying to make sure it's on track to close. For them to call a bluff, like to call your contingency just to try and get you to perform non-contingent, that's risky because you could
You could
jeopardize the
go
whole
away.
deal.
Yeah.
And so I think when you're negotiating that, they may be posturing that, but I would strongly discourage a seller from trying to play that game of cat and mouse and chicken, who blinks first to get something. So if they're gonna ask for that, it could jeopardize the whole
Cat,
deal.
mouse, and chicken. Did you get that? That's my job.
That's cat and mouse for sure.
No, I'm sorry. I'll go now, I guess. That was my fun for the morning. Cat, mouse, and the chicken.
Karma's gonna hit, she's gonna fall.
Yeah,
It's slippery dog.
Now we gotta watch. Chris is like, oh, she really does.
Any questions on that? That's kind of the main differences in that section though, is
So you'll see a date like a couple weeks before closing on that. Like,
typically it's 3 to 4 weeks.
Okay, okay.
Oh, but that's something that, again, if you're ready for a buyer, always check.
Yep.
I would check line 70 and refund it to the buyer, let them come back, and based on the situation, it may be worth it to negotiate or change this,
Sure,
but
okay.
never offer that up.
Yeah, perfect.
Unless, again, I'm just totally brainstorming, unless you're in communication with the agent, and there's multiple offers, and they're kind of giving you a heads up, here's how. A lot of our success is our relationships, not only with our clients, but with other agents. And so we've had agents that, and likewise, you feel comfortable that the deal's gonna be stronger with a particular agent involved. So I've had situations where an agent might say, hey, I know my client, this is what's important to them when you're drafting the offer, which will give me a leg up in drafting the offer. So when I say never put this in initially, unless you've got some indication that, hey, this is important to them, you can get a leg up on your offer by doing this. So. And this section goes all the way on through lines 111. And it can get, I don't want to go into a whole discussion, but it can get into, if a seller's not able to perform, now you're arguing about what the earnest money, who gets it, and it can get ugly. The only options to cancel a purchase agreement are through mutually signing a cancellation or through what's called a statutory cancellation, through where it goes to a judge, which is the legal process. So the way that would work then is one party would say the other party's in breach or not performing, typically the buyer, and they're not willing to sign a cancellation, typically because the buyer wants the earnest money refunded and the seller's not willing to refund it. So they go before a judge, and a judge can issue a cancellation. And then they may or may not decide in that arena where the earnest money goes. But those are the two ways a purchase agreement is canceled. You try and avoid the statutory cancellation at all costs just because if you're a seller, you just want to get your home back on the market, really. And so, but we have had instances where we've had to do a statutory cancellation. It can cost $750 to $1,000 in attorney's fees to do, but it's a necessity sometimes. So that goes through line 111. The next section, lines 112 through 115, is about the buyers locking in their interest rate. And what I would do, I personally, again, this one really, what you're saying is the buyer will lock within 5 days or at any time prior. What I do, again, trying to put it in the buyer's best interest, is I select line 115. However, what I tell them is I would encourage you, especially in today's arena with interest rates ticking up, is I would encourage you, I say, first thing you do once we get this accepted, call your lender, tell them it's accepted, and you probably want to lock in your interest rate. And then I say, if you want to play the game of Russian roulette, if you think it's going to go down, that's up to you. But most people, they want the security of this is what was quoted. I want to lock in right away. So I encourage them to lock right away, but contractually I leave it open. You very rarely see any issues made or countering back on those two. There's the impact of either of those choices is really minimal on a purchase agreement. So now from here on to the next page, all this information is what used to be in what was called a financing addendum. So there used to be a financing addendum for an FHA offer, a financing addendum for a conventional offer, VA, etc. So there's a separate addendum for each type of financing. And what they've done now is they put it all in the purchase agreement, and depending on the type of financing, there's certain sections that are applicable and that are not, which to me simplifies it. So section 116 to 126, what this is saying is lender commitment work orders. Now, there's a lot of different philosophies in how to handle this. What this is saying is if there are lender work orders, and let me just back up, what lender work orders are not the inspection, not the inspector saying X, Y, and Z should be addressed. This is the appraiser coming out and seeing something that doesn't meet the guidelines of the particular type of financing. So for instance, FHA, if there's any peeling paint, if there's any cracked windows, carbon monoxide, smoke detectors, any of that will be flagged. And again, this goes into the discussion of you can try and be proactive as an agent, have those, if you're a listing agent, those items addressed, get carbon monoxide detectors in before you put it on the market, stuff like that. But this is saying if an appraiser calls any of those items, who's paying for it and up to how much. So really and this comes with experience, is there's a lot of factors that go into this as far as what you're going to put in here. If it's a home that has been on the market for 5 months and there's no other offers, you can put $300, $400 in there. And you think there might be issues. If it's a 10-year-old home and there's no issues, then you don't want to make this a big issue. But if you foresee issues, really the condition of the home and the competitiveness of how many other offers is what's going to drive what you put in here. If you're competing against a lot of other offers, I'm generally going to put 0 in here because I don't want, if we have the same full price offer and 3% closing costs, I don't want to lose the deal because I have $200 and the other offer is 0, when they may never get called, right? And so this really depends on the age and condition of the house, you being in it to know if it's likely anything's going to get called, and how highly competitive that property is. Now, if it's conventional, there's very outside of the foundation crumbling, major roof issues, major issues, there's not likely to be lender work orders. If it's a VA or FHA, peeling paint, any of those items I talked about will be called. A lot of times what you'll see, agents, you'll see $200 in there all the time, which is fine. And so when you're meeting with a seller, then you've got to explain to them, you are committing to paying the first $200 of any lender work order. And that's good to put in there. Again, if there's no other offers, and it's a 50-year-old house and something may come up, that's fine. But VA and FHA are where most of the work orders are going to come into play. Make sense? And then what happens is appraisers then have to go and re-inspect the property. Are the carbon monoxide detectors put in? So again, you're going to pay, or someone's going to pay $150 to have the appraiser come out, because showing a picture of the carbon monoxide detectors isn't enough. They need to physically go out there and verify, right? So then this is saying seller, buyer agrees to pay any re-inspection fees. Again, I'm taking the temperature of the entire property transaction. If it's something that I have leverage from a buyer's perspective that's been on the market for a long time, no other offers, I'll put seller agrees to pay re-inspection fee. If it's been on the market 3 days and there's 5 other offers, I'm going to put buyer agrees to pay. And I'm going to explain to the buyer, say, hey, we want to make our offers competitive as possible. I didn't see anything, it's very unlikely, but you may be on the hook for $100, $150, but I think that's worth the risk to try and get the property. Again, I had a house listed here in Sartella, there's 4 offers within 2 days, and we're looking at, the offers were so similar that the sellers are looking at every little detail, because all you have to make a decision is what's on paper, And the littlest things may be the difference of getting your offer accepted or not.
Are you able to see the other offers?
Not from a buyer's, no,
Okay.
no, but the sellers and the seller's agent are gonna be comparing.
Mhm.
And so as a listing agent, you're pointing out each difference.
Yeah.
And when the money's the same or very similar, a lot of times, all the sellers making the determination on are things like a $200 work order or zero,
Which is not fair.
which,
That's
again,
what ours came down to when we bought, so it was just, basically, they could pick either one, so. But I think Christina knew the other agent, and that agent called and was like, hey, if your buyer does this. So,
I think,
yeah, it came down to that, like where it was literally the same, basically the same offer.
yeah, so two things. You just reiterated this point, but to kind of go off topic is, especially when you're starting out, I can't tell you have important it is to have a good reputation with the other agents. It will pay, it's the most return on investment you can have is to have a thorough understanding of the process as well as just not being a jerk to them because it goes a long way.
Yeah.
So, lines 128 through 137. So this says FHA escape clause. You'll notice in parentheses it says FHA only. And Danielle, if you need to go, feel free anytime. What this is saying is in FHA and VA, the appraisal must appraise at the purchase price. So if there's closing costs rolled in, and we'll talk about that in a little bit, it has to appraise for the purchase price. And so FHA, you put in here, if you're making an offer of $150,000, you put in whatever the purchase price is in line 133. And so that's the same case in VA as well. And you'll see that comes down to 148 to 155. Basically, it has to appraise for the purchase price, including seller paid closing costs. Lines 140 through 142, it says seller agrees to pay buyer's closing fees and miscellaneous processing fees, which cannot be charged to the buyer not to exceed, and you put a number in there. Now, this, again, a lot of times you'll see, what that's referring to is in a VA loan, the closing fee to the closing company technically cannot be paid by the seller, paid by the buyer. Don't ask me why, it's just an underwriting rule for VA financing. However, the vast majority of the time, that fee is included in the buyer's good faith estimate. If they're asking for 3% closing costs, it's already kind of wrapped into that 3% closing costs, most of the time. But what this says is this does not include line 142. This amount is in addition to seller's contribution. So a lot of times you'll see $200, $250. I a lot of times just put zero in this market just to make the offer more attractive to the seller. But you'll see 2 or 250 in there a lot of times. Again, what I would tell you, my recommendation is if you're in multiple offers and you're writing a VA offer, I would put zero. If it's been on market, you have a lot of negotiating power, put 250, 225 in there. That's something you'll just gain in with experience.
I feel like the one VA loan, I called the banker, I think, just to make sure there weren't any
Yep.
other, right?
Yep.
Yeah,
And that's a
thank you.
great point too, is in any of this, the lender is going to be the go-to person for the closing costs and fees on the amounts. Lines 143 through 147 is for VA financing only. So again, if you have a conventional offer, you're leaving these sections, FHA clause, VA clause, you're leaving it all blank for a conventional offer. For a VA loan, there's what's called a funding fee, which is a fee that goes on top of any sort of closing costs that, like it says, is a one-time funding fee, and it varies there's a lot of factors, is a lot of service members will have a percentage of disability, and so the funding fee, if a veteran is 100% disabled, there's no funding fee. If they're they're 50% disabled, don't quote me on the percentage, the funding fees reduced. It's based on if the veteran, yes, there's a lot of factors, which the lender will go into. Here's what I can tell you, what 99% of the time is added to the mortgage. It's not paid at closing. Now, once in a while, you might have a service member say, I want to pay this at closing. What I do is, because it's not necessarily known right away, the amount, a lot of times it is, but some of the time it's not, but what I do is on line 145, I will put TBD, to be determined, paid, I check added to mortgage. And so all you want to do is assure the seller that it's not going to be their expense. Now, the conversation is going to be between the loan officer and the buyer, what that funding fee is and how it's getting paid. Right?
Yep.
You just experienced that, I'm sure.
That's why I called the bank office.
Yep.
Yeah.
Yep. And so when you're drafting an offer, your goal is just to assure the seller that it's not going to be their expense. And then you can, this
And
is just-
majority of the time, all those veterans know going into it that they have funding fee. So it's not
Yep.
that much.
Yeah. And again, just subtleties, little things. When I do this, I'll like make a big zero with a line through for seller just to like amplify the fact that they're not paying anything. And then you'll see what we covered, lines 145 to 155 of the VA escape clause, meaning it has to appraise for the purchase price. Now, in addition, just for a heads up, is after a purchase agreement is executed, so the FHA escape clause and the VA escape clause is in here. Most lenders will have additional forms that come after the fact that say the exact same thing, the VA escape clause or the FHA escape clause. And then there's also a clause that all parties need to sign, both agents and buyer and seller, that basically just says it's their statement that they're not misrepresenting everything in the purchase agreement, that they know is true to what they know. So it's just like a statement by all parties involved that they're not misrepresenting something in the purchase agreement. So that comes after the purchase agreement is executed. So it's just kind of a heads up. Section 158 through 166 is sellers paid closing costs. And so when you're asking for seller paid closing costs, and I'm not going to get into Homes for Heroes and how that can work, because that's a whole other topic as well too. And I don't even think we've discussed what Homes for Heroes is. And
Not too much, a little, maybe I do a little bit.
yeah, we give rebates or discounts to service members, firefighters, police officers, etc., which can be used as closing costs. So just ignore that for right now, because that's a whole half-hour explanation on how that works in. But if the lender says they can use 3%, which is the common, VA, a lot of times you see 4%, you can put in, you want to check is or is not. So if they're paying their own closing costs, you check is not. If a lot of times they'll just do a dollar amount. So like I had a client this week where it was buying, it was over $400,000, so their closing costs were like $9,000. We only asked for $5,000, so we checked line 160, wrote $5,000 in. A lot of times if you're doing an FHA offer, it's going to be 3% or even conventional, you're just going to check 3%. Now the key thing to know here is, and as you get relationships with lenders, you're going to know who are the astute ones to calculate the closing costs or just say, oh, ask for 3%. What you don't want to do when you're representing your client is leave money on the table. If you notice what it says is, if they are not able to use all the closing costs you asked for, it stays in the seller's pocket. So I want to know if I'm asking for 4%, I want to make sure we're using all of that. So a lot of times I will get a good faith estimate, which is an itemization of all the closing costs. And if it comes down to, if it says $6,700, what I'm going to tell the buyer is, I'm going to say, let's ask for $6,000 and say your earnest money is going to cover that other $700. This is an estimate, so depending on when it closes, there's different prorations of taxes. I'm going to say, I would rather have you bring, again, you got to take the temperature of your client and their finances, but I would say I'd rather have you bring an extra $300-400 by underestimating it than overestimating it and leaving $300 or $400 in the seller's pocket. That's kind of my starting point. Now, I'll say this, if you have clients that have no money, it might be the reverse. You might want to overestimate it and leave a couple $100 in the seller's pocket because they don't have the extra $200-300 to bring, right? So you really got to make that judgment with your client, but I always start out with, I would rather have you bring $400 extra by underestimating it than leaving it in the seller's pocket. Does that make sense? Going a little bit of a different direction on a tangent. On a bank-owned foreclosure, this is more liberal on what can be used for closing costs too. You can basically use home warranty, you can use almost anything because it says other costs allowable by lender, which is vague. You can use almost anything in there to cover if you're trying to make up a gap. You can add in a home warranty or something like that. If you're selling a foreclosure or a bank-owned, that's going to be very limited, and that's where you have to pay extra special close on what the amount you're asking for, because you can leave that in the seller's pocket very easily on a foreclosure. If you get in that situation where you're making an offer on foreclosure, first of all, come see me with seller paid so we can kind of, because every bank's forms are a little bit different. But I just want to point that out, in a bank-owned property, it's much more stringent on what can be used for seller paid closing costs. Make sense? Any questions on anything? That's it regarding the financing sections. I know it kind of feels like we took a drink of water out of a fire extinguisher here. But did that answer your guys' questions a little bit?
Yeah, it's good to go through it again.
Yeah.
Yeah.
So it's like if it's 7 o'clock at night and you're writing up a purchase agreement and you haven't spoken to their particular lender and you just say, I'm not submitting any of this until I've called the lender and gone through all of that.
It depends.
Because if they won't know.
I'm speaking to the other agent saying, are there any other offers?
Yeah.
Something like that. And I get, you can get caught up in that situation where it happens so fast and you're not prepared. And you don't want to lose the offer. I would, if it's one of those where there's other offers on the table, I'm probably, with permission of my clients, submitting it.
Okay.
And then I'm following up with the lender first thing in the morning or that night just to, if we got to tweak something, it's better to do it sooner than later,
Okay.
right? Not get your offer submitted
Right.
if there's some urgency. If there's no urgency,
Then yes. Yep.
then the next morning. The bottom line is you're always balancing risk reward of obtaining the end goal, which is getting the house, versus putting your clients in a precarious situation. And the end conversation has to be with your clients. This is the risk. Are you comfortable with it?
Sure. Yep. Yep.
Make sense?
Yep.
Anything else?
The pre-approval letters
Yes.
from the bank. So, can you talk about, so at one point, especially in classes, they said you never want to have like a dollar amount on that letter, right? It just needs to be, this client is approved to purchase this home at XYZ's, whatever. But yet, a lot of them come with a dollar amount. And so, what is best practice?
I don't see a huge detriment to it. A lot of where that comes from, there's just different viewpoints on that. A lot of lenders will have their own policies on not putting a dollar amount on there, or they will. Some won't, some will. What I would say is the only thing you don't want to do is if you're making an offer on a $250,000 house, you might not want the letter to say they're approved up to $300,000.
Right. So could you just ask, you could just ask the lender, like, hey, we're submitting this offer at $249. Can I have a letter for $249?
Yep. Or some lenders will just put the ad, they're approved for that property address.
That
They
I
don't.
feel like I've seen both.
There's online lenders where literally I've sat in a room where the buyer can go in and type in the amount they're pre-approved for.
We don't want to go.
And I believe there's safeguards in that where the program, the lender puts in their approved X to Y. It's
Sure.
just more of a facilitating where the buyer can do it, which is I get, but,
Yeah.
so that's a more personal preference thing. My only take on that is just don't put a blue sky above the purchase price.
Yeah.
Because then the seller knows, hey.
Yeah.
Oh, hey.
Can you redact it, like, let's say it's a bank in Ohio that you just can't get a hold of him quickly, but yet you have this letter up to $400,000, but our offer is at $340. Can you just redact the, like, dollar
I
amount?
wouldn't edit anything on there or cross anything out.
Okay.
I would then say, look, again, it gets back to, is there urgency to get the offer in? I'd say, hey, we may need to submit it. I'll follow up with the agent and say, hey, we can get you an updated one. What you'll see common places, and again, as a listing agent, you kind of go forward with it depending on your comfort level with the lender, the agent, et cetera, is you'll see a pre-approval letter written for a different property address. They lost out on that house. Now it's the weekend and they submit it just because they want to show that they're
Yep.
pre-approved. And if the property address is listed at a price above mine, I feel comfortable to present it with, knowing that I'll follow up. Again, if it's a lender agent that I'm familiar with. So, I had one just this week that was a USAA, and it said they were pre-approved for Stearns County, Minnesota, and the property's in Benton County. Am I gonna make a big deal out of that? No. But it really, a lot of it, what you'll gain is the experience comes down to your working relationships with the particular lenders and other agents, just how far you feel comfortable working with situations like that based on, the people involved. If it's a Quicken loan, it's a little more difficult than if it's a local bank here that you don't deal with.
I think selling it too is that when I talk to other agents, like, hey, we're working together to close this deal together, and that we're both, the end goal is the same,
Yep.
So I feel like that's how I try and put some enthusiasm around my conversations, I think, with other agents. Let's get this done together, we work together, so.
What topic, I can come up with some too, I got a couple, but are there any pressing topics you guys for next time wanna?
No, it's good.
Just here to listen.
And again, Danielle, Courtney, we go through this entire purchase agreement start to finish, so don't worry about missing anything, but is there anything, kind of covered inspections, contingencies, financing?
Maybe you're just given, just an idea, but given how busy Sartell is, right? Things move very quickly in Sartell. Could we talk about, like the seller needs to find suitable housing?
Mapping a plan, how to get your client from point A to point B based on their scenario. Yep.
If
that's
not
excellent.
next time, then, I just
No.
think,
Because that's very relevant.
I'm watching these houses in Sartell are contingent inspected, it's the next day, and that.
Yeah.
And so this is,
It's like, well, where are
again,
they gonna go?
this is what sets us apart, or will set you apart, is be able to go to a client. It's not just, because anyone can go and fill this out and list your house or do this. It's being able to say, here's 4 options to, you want to move, but your house isn't out there, you don't want to sell your home and be homeless. How do we put this puzzle together and give you options? That's really what the value you can bring and add. So that's excellent. We'll, we're gonna have 2 weeks from today again, same time. Do 10 o'clock. What day is next?
I'm not going anywhere, anyone else, but.
It's March 15th, not us.
I have a closing at 9 that day,
Should we do 10:30?
but, yeah. I should be able to get here by 10, but
No, we'll plan on 10:30. And Danielle, you're welcome, for sure.
10:30,
Yep,
15?
yep.
yes.
We've kind of just adopted every other Friday, and in the summer that might get to be a little tougher, but it's good because today, of course, it was just more me talking, but it's better when we can talk about our situations and just bring up, and that's gonna happen in the spring and summer, where we're gonna just be talking about what do we have going on now and how do we navigate those. So you might be dealing with a situation, and then we can all listen to it and say, because it's all gonna come to all of us, right?
And I just feel like when you're in it, that's when you can connect the dots.
Right.
And
You hear so much in your class and you're like, okay.
yeah, it's
Ugh.
hard to connect it to something.
So, yeah.
I'm
So it's out. Oh.
You are, I
Yeah,
know,
yeah.
Oh,
Which
I'm
I actually
so
don't
sorry.
mind. I don't mind it, but yeah, it's dry. It's
Classroom versus reels.
so
I went to the real one.
I went and sat in all 3 weeks of classes and it's just,
So much better, you think?
I just think the reality,
Just compare
you're
to
hearing
what-
textbook and then,
Learning and living this.
yeah, it's so different.
Did you go to the city?
Yeah, I went to the same class.
So I don't think there's any in town.
No, there's not, which blows my mind, I still don't understand that, but, yeah, so, it's good.
But I drove to Kaplan for all my tests.
Oh, you did?
And I went to Edina for like my final one.
Okay.
I couldn't get in St. Cloud.
Yeah. Again, I mean,
In St. Cloud, they only do it in the middle of the month, like the 15th, 16th, 17th. And I was like, I don't want to wait until the middle of March. So I had to drive to Pine City, which isn't terrible.
you'll learn more spending a day with Heidi Fowler on Shatter
For
than you will.
sure.
It
Then
was a 3 week
3 weeks
course.
class.
Yeah.
You are done with yours?
Yeah,
nice.
yeah,
Yeah.
I'm just kind of curious.
Yep.
Yeah.
Cool. Well, thank you